on board Mittul Kalawadia, who is the fund manager of ICICI Pro Dividend Yield Equity Fund. So let's bring him on board and understand more about this fund and his current views on the market setup. Mittul, good evening and welcome to the show. And I will ask you about the fund, and we'll know the exact allocation and how it is important for investors to have this kind of fund in the portfolio. But then before that, what are you reading about the market?
Yeah. See, in terms of macro setup, if we see from an India perspective, then there are not many negative things that you can now talk about. So there was a time from October 21 till now where there were some uncertainty which on the macro front, which actually created volatility in the markets. Now, most of those uncertainties are behind, and there is more certain about the chain of events that will play out. Either it is in terms of, let's say, the commodity prices where they are, or if you look at the current account deficit, which is a concern for India, all those concerns are no longer a big concern to be worried about. And then if you talk about US interest rates and all, there also the trajectory of the chain of events is more or less certain. So the uncertainty in the market has gone down, and not in markets, I'm saying in uncertainty on the macro events has gone down. And that should essentially mean that overall markets, if there is a good earnings trajectory over the next 4 quarters, then market should be in a good shape. So of course, there will be some volatility within the markets, which is the basic nature of the market to be volatile. So it's not always a runaway market which we expect, but we expect more of a moderate return markets and after a long period of consolidation, which we have seen in the past 1.5 years.
All right. Even if we exclude the scenario that we are, or the booster that we are getting from the FII's end, you still think that we are on our strong grounds?
Yes. So, see, the current account deficit has come to again a comfortable zone where our currency will be more or less in a stable zone. And any stable environment is good for businesses because then the predictability of pricing, either on purchase or on sales, is always high. So, exports and imports both can happen at a regular pace without much volatility. And when there is lesser volatility, it also means that people can predict their margins, plan their business operations in a much advanced way. So overall, it's a good scenario to be
into. All right, Mithul, let's talk about your fund now, and let's help our viewers understand what's the kind of strategy you've adopted in the fund. So, ICICI Dividend Yield Equity Fund. Basically, what's the idea behind any dividend yield fund? Let's just start with this.
Sure. See, generally when the term comes like a dividend yield, people think this is a like of kind of a very safe fund, a fund which will be investing into high dividend yield companies. And that essentially means that also the indirect meaning of this will be that it will be a low growth or a kind of a no growth kind of a fund where the companies will be actually at a mature stage of businesses where they don't need so much of money, so they are paying dividends. And you would earn returns which will be nothing but yields, dividend yields out of these stocks, and there will be hardly any capital appreciation. So that's general, I think, a popular thinking which everybody would have. But the way we run our dividend yield fund is a slightly different one. And if I were to summarize for all the viewers in a very simplistic manner in a one line, then our dividend yield fund or the way our strategies is, this is more like a diversified fund which invests into various sectors, various kind of market caps of this economy. And at the same time, this is a fund which is run based on an approach which is called as a sustainable yield approach. Now, what is this sustainable yield? If I were to put it in a very simplistic way, you try to look at stocks which have a very high dividend yield or a cash flow yield, and then you eliminate some of the stocks based on the sustainability of their dividends and cash flows. And in this elimination process, you try to rank stocks with a higher or a better growth prospects, along with the stocks with the stability of their dividends and cash flow. Those kind of stocks, you give them a higher weightage in your fund. And in this way, you create a portfolio which is a combination of bottoms up and quant quantitative analysis, and this is how you create an overall portfolio which will keep changing over a period of time depending on what is relatively more attractive at various point of time in market.
All right, let's talk about your exposure in different sectors and accordingly your exposure in different companies. Sustainable dividend growth, that's what you mentioned, also with a diversified approach.
Yes.
Looking at the current market scenario, what are the companies that you're betting on? What are the stocks in terms of sectors? You can't be talking about stocks, I guess. So
Yes.
what specific sectors are you looking at? And within those sectors, what kind of companies are you looking at for better sustainable growth when it comes to dividend to your investors?
See, one of the big, most positive sector that we you can see or in terms of weightage in our portfolio is the power sector. There are a couple of power companies, both on the generation as well as some on the capital goods side, which is part of our portfolio. And this is based on a very simple, longer term understanding of how the sector is performing in terms of its cycle. If you look at the power sector, then there was a cycle in the power sector between 2000, let's say 1 to 2012, where it was constantly in a deficit market. There used to be huge power shortages. There used to be huge power demand which was unmet, and that defined that decade of power cycle. Then what happened? A lot of power supply was being planned because the rates were high, the ROEs were high, there were policies which were favoring more generation. So those power plants then, and it's a long gestation period. So it takes around 5 to 8 years to get up a power plant up and running. And by 2015, the sector started to see an oversupply, and then we saw a continuous from 2015 till 2020, we saw an oversupplied market. And that depressed the earnings of all these stocks, all these companies. So, and a lot of companies failed to survive in the sector. Ultimately, the sector got consolidated and now it's up. And over this long period, slowly and steadily, the demand kept on increasing. And demand is very simple in terms of energy. If you see, with there is a high correlation with GDP growth. No country can grow without an appropriate source of energy. So demand continued to grow along with our GDP, and it would continue to grow. So and this is where, and if there are no more supplies being planned in the manner which will take care of peaking power deficits, then again we will see a couple of years of good investment opportunities for the sector. And that is why, if you look at some of these stocks people thought were completely unattractive. People thought it will be a low growth sector, absolutely no interest in the sector. Along with that, there was a one more event which affected the sector, which was ESG in 2017, 18 to 20. A lot of global funds started adopting ESG, and a lot of thermal power plants in India became an unattractive opportunity for them. So they started exiting some of these stocks, and these stocks became a very attractive investment opportunities for the investor. So we like this sector today. Also, if you look at the valuation of the sector, some of these listed power plants are still trading at much cheaper compared to 2008 peaks. So something like some of these generation power plants used to trade at 2.5 to 4.5 time price to book in 2006 to 8 period when there was an upcycle. Today, these are still at around 1 time price to book or below, and attractive yields of upwards of 2 to 4% in many of these stocks. So it's a very interesting sector. Now these companies have addressed the ESG issue to some extent. Many of them are investing into green renewable energy source. So those issues are not so much of a worry, and at the same time they are enabling India's growth engine. So we think it's an
What is
important
the
sector.
right? What is the benchmark that the fund is tracking, and what's been the dividend yield?
So the benchmark which the fund tracks is NSE 500. So it's a broad index which is kind of used for most of the flexi cap or a diversified kind of funds. So broadly, that's the benchmark which generally gets used for most of the dividend yield funds now.
So far,
If you
yeah.
Sorry, if you look at Nifty's dividend yield, it's something around 1.5%. That's the kind of index dividend yield in on a broader.
But Mithul, if the markets have been very volatile, that also we've seen in past few quarters, these funds really won't help you make a lot of money, right?
No, actually, if you see the only scenario where these kind of funds have a slightly more volatility and a challenging time is the uncertainty of whether there is a recession or no. So it's only during those recession time it becomes difficult to predict what will be the cash flow yield and what will be the dividend yield which will be sustainable. But apart from that, generally this strategy of looking at a sustainable yield has been a good across all time periods or across all phases of economy. They tend to do well in the recovery phase of the economy. And at the same time, in a stable environment, also there are always good opportunities which keep coming here. Just to give you some small example, like if you look at today, the high yield stocks or the high yield framework based sectors versus the low yield, which is generally the high growth sector today. The high growth and the low yield stocks are still pretty expensive compared to their past, even after a good time consolidation or some correction of prices which has happened. Actually, either there is some disappointment on growth side or disappointment on some profitability side, which has led to some of these stocks continue to remain very expensive. Whereas if you look at the other high dividend yield and the high cash flow yield stocks, they are really still attractive despite fantastic returns that they have already generated in the last 3 years. Despite that, the valuation gaps between the two remain as it was in 2.5, 3 years back. So we still think that it's a very good investment opportunity for investors to look at high yield or a high cash flow yield, dividend yield kind of a framework of investing.
Mithul, now this type of fund is definitely not the one that you want in your core portfolio. This can be like an added diversification. There has to be a certain need to have this kind of a fund in your portfolio. So, who exactly should be investing in this kind of a fund, and also what's the tax implication for this kind of fund?
Sure. See, I'll answer it a bit differently. I think this can be part of your core portfolio. So if you were to slightly take a slightly broader approach and think about it, this fund is very similar to what you see in all the other flexi cap or a diversified kind of funds, right? It can invest into large cap, mid cap, small caps. It can invest into all kind of diversified sector. And if you look at our sectoral diversification, also you can find most of the sectors having representation in the fund. So it can be part of a core portfolio with it actually adds to a differentiated style. Most of these flexi cap or a diversified fund will be either a pure value or a pure growth. Here it's a more of a blend approach between the two. We try to marry some growth into our portfolio through our sustainability factor, and then there is a value angle which comes through your high yield factor. So there is a blend of both which works over here, and I think it can be a part of a core portfolio rather than just being an added here. Coming to the sorry, what was the second part of the question?
The tax implication. Yeah, yeah.
So coming to the tax part of the overall discussion, see, for mutual funds, when they receive dividends, it's more of a trust structure because it's not our money, it's the investors' money ultimately. So those tax structures are having a tax advantage. They don't need to pay tax on those dividends which they have received. At the same time, when the investors have invested, and since these money get redeployed into various stocks again, there is no implication of tax on dividends for the investors which we receive from the companies. Now, if an investor has invested into a growth NAV, then as long as they continue to remain invested into those funds, they don't need to pay those tax. So in some sense, it is more tax efficient form for an investors who are more longer term investors with a longer term horizon, and we think it's a good way to invest into dividend yield.
All right. Thank you so much, Mittul, for being on the show and helping our viewers understand this particular fund and the category that's useful for the investors for their portfolio. Thank you so much for being on the show. On that note, let's